Ultimately, for us, ESG is a risk factor because anything that can impact the bottom line of a business is a risk.
Hello and welcome to this special video interview. I am Natalie Kenway, Global Head of ESG Insight at ESG Clarity, and today I'm joined by Stuart Ryan and Stuart Smith, Head of Research and Head of Managed Portfolio Services respectively at Rsmr. The pair and their team are responsible for researching funds for the firm's ratings business and managed portfolios, which features a risk-rated response range. Thank you both for joining me. Firstly, can you talk us through briefly how you rate funds, the processes and the outcomes?
The initial universe for Rsmr for our open-ended funds is the Investment Association, and for closed-ended products, it's the Association of Investment Companies. Now, Rsmr are primarily focused on qualitative analysis, but however, due to the size of the universe, it's circa 4,000, say for the IA, we need to use a set of quant screens to make that more manageable. And those quant screens will cover areas such as a minimum fund size. Typically, we look at 50 million as the cutoff for liquidity reasons, a minimum track record of the strategy or the manager, the investment process. We use proprietary analysis covering performance, risk-adjusted returns, volatility, as well as peer group comparisons. And then if the fund is selected to progress further by the Rsmr Sector Committee, a bespoke RFP questionnaire will be requested for completion by the asset manager. Now, this is a detailed document, and this covers areas such as the investment process, risk, ESG, and the fund management team. Now, the review of that will then be fed back into the Sector Committee. This may require some additional questions, or it might actually satisfy that to progress to the next level, which is most likely we would say the most important part of the process, which is the qualitative side. Now, that requires a face-to-face or virtual meeting with the management or the management team. And that's where we really do get underneath the bonnet of the fund. And it's an important part of the process because we can see through the noise and get through sort of the what you're being told versus what you actually see. So this is very critical to us. Now, that information gets put into a full written note, which is then fed back into the Sector Committee, which is scrutinised, and questions come from the remaining team to make sure that there's no bias, confirmation bias coming through from any individual. And then from there, either a rating's awarded or it's not, or when we're in the responsible side, we then have to take it to the next level. So that means the fund has to either sit in within an ethical, a sustainable, a thematic, or an impact category.
Stuart, can you give me an overview of the responsible MPS that you run and what sets it apart from competitors?
We run 3 model portfolios, so cautious, balanced and dynamic, as we've named them. The asset allocation we've based around a standard asset allocation for a non-responsible set of portfolios, but we've then tailored them towards the assets that are currently available in the responsible space, and we will continue to do that in the future should more options become available to us. The underlying fund selection is very much based on the research process that we've highlighted. So the portfolios will solely consist of funds that are rated responsible by Rsmr. So they've gone through the rigorous research process. We understand the responsible, sustainable or ethical nature of these funds. And so we're able to put them together in terms of a portfolio, put like funds together and construct them for the appropriate risk levels.
As I'm sure you're aware, there are lots of funds being launched into the responsible investment market at the moment. How do you unearth the greenwashers?
One of our initial areas is that we do not deviate away from our initial criteria of a 3-year track record. So that way we are screening out the kind of new entrants to the market. So we don't deviate from that. That's like a part of our process. And from there, the qualitative assessment is a very good way of kind of filtering through the noise. So if we can sit across the table, across like we are today, across a virtual meeting, we're able to really get underneath the bonnet and understand what is actually being done versus what is being said to be done. And also, because we've been active in this space, Rsmr, since 2012, and myself personally since 2010, doesn't sound like a lot of years, but it is in this industry, 10 years plus. It gives you that kind of critical eye to be able to see who's doing it, who isn't doing it. And it's that kind of attention to detail that we can tease out the key facts to as part of the research process.
In my research about what you guys were up to, I came across something where you said ESG is a risk factor in all funds, not just those that are choosing to invest responsibly. Can one of you elaborate on that?
Ultimately, for us, ESG is a risk factor because anything that can impact the bottom line of a business is a risk. And environmental, social governance factors are equally as important as other metrics you would look at when assessing a business and ultimately a fund that invests in those businesses. So for us, it's part of our due diligence, and we've got to make sure that those areas are all covered and stack up to the sort of scrutiny we expect.
To follow up on that, as Stuart said, ESG is a risk factor, so it's part of risk management, and we think increasingly that ESG will become a standard part of risk management for all funds, and therefore looking at funds in the isolation of ESG we think will become a decreasing factor going forward. And in terms of how we then look at responsible and sustainable investing, it's taking it one step further. It's going beyond ESG, looking for firms within their investment process that use positive factors to support businesses that are making changes to environmental, social, governance and other areas. So that's really where we think we differentiate ourselves.
Advisors are facing lots of regulation around sustainability in advice. How do you think this will shape the industry going forward?
The direction of travel. I think younger investors are going to expect this as the norm. It will ultimately lead to an improvement of standards, and it will become part of the KYC process for when you're ensuring you're giving the advice to a client it's suitable. It needn't be onerous, but I know it's going to be a change, but it's ultimately going to be part of the industry and a welcome part.
Well, thank you both for sharing your insights with us. It's been really great chatting with you.